What is up, ladies and gentlemen, boys and girls, clients, real estate agents, loan officers, and anybody else? Welcome to the Monday Market Update. My name is Sean Grapevine, Vice President of Product Strategy, and I'm joined today, momentarily, hopefully, once he upgrades his internet from 56K dial-up to the 21st century's offering of internet, joined by Matt Gougé, a loan officer extraordinaire, Matt the mortgage guy to some, and great friend to many. We are here to discuss the market, its effects on you, wherever you are in that market, whether you're a client, real estate agent, or loan officer, what we think is going to happen, and what has happened recently. As I say every week, I'm the Vice President of Product Strategy. I would not fault you if you, dear watchers, had no idea what that meant. But that means here at UMortgage, I run the team that is responsible for creating the solutions and software and little apps and various things that, hey, it's Matt.
Hello. How we doing, buddy?
Good. Welcome back. I was just ragging on you for your internet connection, but pretend I didn't say anything. Okay. Nobody tell them what I said, please. And it was also, every week I come on here and I say, I'm the Vice President of Product Strategy. And I was saying, I bet you nobody knows what that is. You may not even know exactly what that means, but I think you've seen the fruit of my labors enough to understand. But essentially, I create I run the team that creates the software that allows us to our loan officers and our partners and our clients to stay consistent. I think one of the reasons UMortgage has had the success that it has is, through the bright times, which honestly, economically, there have not been many in the mortgage world since we started. We had somewhat bad timing in starting a mortgage company. And through the tough times, the reason we are number 88 on the list of 5,000 fastest growing companies in the United States is because of our consistency. And that's something I try to bring into my work every day and systematize and hand it back to people so that they can take the things that they know that work, the proven processes, and turn them into consistency. And the reason I say all that is not to brag, although that is just a happy accident that happens along the way. But also to say, what I've realized is you don't necessarily have to be great at what you do. You don't have to be the very best. You don't have to be the GOAT. You don't have to be Matt the mortgage guy. You just have to be consistent. And I also think when I was working with clients, the clients who really got sometimes I was surprised by lazy clients. I was like, this can't be the house that you want. This can't be the best deal you could have gotten. You didn't do a good job of shopping for yourself. But then you saw other people, right? They went to the open houses. They interviewed multiple real estate agents. They reviewed loan estimates from multiple lenders. They made choices based on level of service and, quality of execution and ended up with the deal they wanted, the house they wanted, at the time they wanted, with the people they wanted to work with. And I can't say enough about the importance of consistency in all whatever role you happen to have in the mortgage or real estate transaction. It matters. Just your part in it matters and staying consistent. And oh boy, he's gone. Anyway, I wasn't giving him any chance. I was giving him any chance to talk anyway, so it's fine. I was just on my little monologue.
Yeah, no, it's good. What I think about too when I think about all the technology team and all the cool stuff you're doing to help, deliver value to clients and whatnot is there's guys like me that are extremely handsome, extremely great at loan originating, but I'm not a tech wizard, right? And so if it was up to me to create some of these tools, to create some of the software technology that, helps us stay updated with partners, with clients, bring value to them and whatnot, it wouldn't happen because that's just not my skill set. So it's great to have the team that runs that so I can focus on, my area expertise, which is I love messing with numbers. Let's jump on a call and figure out mortgage, structure, and let's talk about how long you're going to be in this home and why it might make sense to do a 1-0 buy down, or for you, you pay points or you don't. And so with that in mind, thank you to you and the whole, tech team for all the cool, gadgets and gazmos and all the stuff that you guys are working on behind the scenes. Much appreciated, because truth is I can't do it.
Yeah, it's all I ever really liked when I was a loan officer anyway. It was just like, how can I create a system? But speaking of systems, let's talk about the macroeconomic system that is the United States economy. And let's do the numbers. There we go. Man, Matt, the more things change, the more they change. The market is shifting quickly. And for those of you new to these charts, this shows the percentage chance via implied odds based on bond traders' activity. So what you need to know is this just shows chance of rate cuts in upcoming Fed meetings. The next one is November 7th of 2024. And right now we are currently at the Fed funds rate is actually a range of rates. If I knew how to explain it to you, I would. That is where my understanding ends. And right now it's between 475 and 500. And one step down would be 450 to 475. Wildly, Matt, we're at a 15% chance of no change, only 2 weeks away from the meeting. And that is up from, 0% a month ago, 9.5% on Friday. What happened this morning? I'm literally nothing's happened. There's no news, but rates are just through
What's
the roof
funny?
this morning.
Yeah, I looked and I couldn't find it. Mortgage rates are up 30 basis points, so rates are worse 30 basis points this morning. The 10-year treasury, I think it's at its highest level of the year at 4.15. And even I watched some Barry Habib and some other stuff, and there wasn't any direct correlation to anything specific happening. Just rates are worse today. Sorry, guys.
I think, yeah. I think people are coming to terms with the fact that there really might not be a rate cut, and nobody had their money arranged properly for that. And I would expect that this number, right? Even this is that information is half an hour old at this point. I bet you if I were right, I bet you it gets it's the same. But I bet you, it continues to fluctuate throughout. I would. That's all I live for, hearing interesting things.
Live for interesting stuff. This morning, I listen to my buddy Barry Habib pretty much every morning, and he's got a morning market update. They showed the first 3 weeks of October in 22, 23, and 24. And there's this weird trend where the first 3 weeks of October, mortgage rates are up, 10-year treasury is up. Again, no real pointing to this is the specific economic news that does it. But it was interesting because Barry and his team this morning were well, it turns on October 21st as of 22 and 23. So if it does the same thing this year, this is the peak, and then we'll start
Matt. What are we going to do about your Maddie? All right. Caden, let's give this guy the axe.
I don't want to.
All right. All right. Our erstwhile companion and host and loan officer has left the building momentarily. No, Kyle, don't you dare. Don't put this on us. He's in his house. That's a very funny joke. So, Kyle, would love to hear from you or anybody out there in Listenerville, Watcherville, if you guys have any questions about the market or about particular scenarios you're dealing with in the mortgage world. Matt, Kyle says you need to hit up the tech team that you're that you love so much about the internet.
I'm telling you, can you hear me? Okay, I'm on my phone now, which is more reliable apparently. But like, speaking of tech team and speaking of companies, like, I pay my internet provider out here in California. I really think this area has spotty internet as part of the problem, but something about customer service in 2024, it blows my mind, dude. The thought of like being even able to get through a call tree to a human being and just say, here's my issue. It's pretty simple. Me don't have good internet. Me want better internet. Like it, I don't know. I haven't resolved this problem that honestly we've had multiple times this year. Because it's so hard to carve out.
I'm with you. I mean, 100%. They've got the sort of like, but it's better for them, right? Like, they've got, how many internet service providers could you possibly choose from? Probably not too many. The thought of changing from one service provider to the other, such a huge pain. And the thought of reaching them is an even bigger pain. So they've solved their customer service problems by not having it. And
right.
It's just like,
don't reach out because you'll never get us.
Which I think is like the typical, like the mortgage approach too, for most like big banks and big lenders and stuff like that, where it's like, well, like I bank with Bank of America. I don't even know if Bank of America still does mortgages, but like, I guess I'll just get it through them. And then, you're just kind of like stuck in there. It's just as hard to disengage as it is to engage because there's nobody to talk to. That's not an issue you run into with independent mortgage bankers and brokers like UMortgage and specifically Matt, the mortgage guy, Gougé. His parents wouldn't have named him Matt, the mortgage guy, Gougé, if he didn't have great customer service. All right, let's finish this up. In December, we've now got a small chance of no change at all from now until the end of 2024. We've got an increased chance, 33% or 1/3 chance of there being just one reduction between like on November, maybe December, maybe November, not December, maybe not November, yes, December. And then we still got a 63.8% chance of 2. But like, just looking back, don't forget, this was at 5 steps down 3 weeks ago. That was the going wisdom. They're going to be 5 steps down. We were like, was it going to be one in October, or 1 in September, 2 November, 2 December, or 2/1/2, or 1/1/2, and now it's like those are not on the menu. Meat is not back on the menu, boys, as the orcs from Lord of the Rings would say. Moving forward, now we have this introduction of a chance of no change in January, a chance of just a 1 step down. So no, yes, or no, yes, no, or yes, no, no. Or you've got chance of 2 total steps down in January, and then 3 is still barely edging that out in terms of like there will be 3 months or 3 meetings and 3 reductions. I would expect these numbers to continue to go down. Of course, it's all going to have to do with what the Fed says on the 7th themselves, and we just don't know what. Like, we have no idea. My guess is that they have been very averse to rocking the boat. Although I say that, and they did a double reduction last meeting. So maybe it's just all gloves are off, and they'll just do whatever they think is right.
Yeah, it'll be interesting to see because I think that last meeting, some stuff was said, and they've continued to kind of paint the picture that the jobs data is now like the most important piece of data. They like, if they said it outright or not, I think that the tone is like, we feel like inflation's under control, so we're not even really like weighing that as heavily as before. But we're gonna continue to watch. What's their mandate? Like stable employment, full employment, stable prices, and something
manageable. Yeah, exactly. And then if you look at the jobless claims numbers from last week, the economists expected 260,000 jobless claims, so 260,000 new people saying I don't have a job, and instead there were only 241,000. So not a huge difference, but yet again, fewer jobless claims than expected, and then retail sales were up. They were expected to be at 0.3%, which would have been 0.2% higher than the previous month, but instead they were up 0.4%. So retail sales are up. If you're the Fed, you're like, why would I reduce rates when everybody, according to our metrics, whether you can beef with the metrics if you want, but like according to our metrics, everybody's got jobs. According to our metrics, everybody's spending money. According to our metrics, like inflation is coming down, but it's coming down slower than we'd like it to. There's if I were a Fed governor, I'd be like, I'm not going to waste these rate reductions on like what people want. Next economic crisis, we need these rate reductions to actually fight the thing that they exist to fight, which is contraction. And like, we're not in a place to contract, according to the numbers.
According to the metrics, yeah, and that's where, like, I don't know, like, there's no way. There's got to be some, person on the Fed board. There's got to be some voice of reason that's like, hey, listen, some of this stuff, the data might lag. Some of this stuff, the data might be based on a sample. I think some of the jobs numbers, they usually do a survey of however many thousand, and they got like only 60% responded to that survey. And they're like, forget it. We'll use that number anyway. We'll use that number to gauge the most important, lever we have in the whole economic system, even though only 67% of people reported. I mean, I'll shoot honest with everybody. I don't have a lot of faith that these numbers are anywhere near accurate. In my world, the people that I talk to don't have a lot of money to spend. Retail sales can be retail sales with a credit card. And this jobless claims number and the strength of the jobs market, I don't know. I just don't buy it, Sean. That's the truth.
Yeah. But I think it's important to note, like, I mean, I think there's like three things where it's like you believe in the numbers and you believe in the Fed, like the people who are on it. And then there's the like, you don't believe in the numbers, but there's like some nuance. Like, to me, it's like never attribute to malice what can be explained by stupidity. I think when it comes to the government, it's never attribute to malice what can be explained by like bureaucracy. I think it takes an act of Congress to change how the Bureau of Labor Statistics calculates their job numbers. Everybody's like, why is this wrong? And they're like, well, I don't know. We came up with this freaking calculation in 1987. We just put the numbers in. What I mean? It's like
40 years ago. I'm sure it works fine.
Yeah, before Uber existed, before like the gig economy existed, where 3% of workers received 1099s, and now it's like 27% of workers. So I do feel for the like, and I don't think it's easy to be like, hey, we're going to change how the federal government calculates employment and have that be like a smooth process. I'm sure it turns into a battle. And I mostly believe that there's nobody on the Fed board. No, I all the way believe that there's nobody on the Fed board that's like, yeah, like, I hate Americans having jobs. I love pretending like they do. You know what I mean? Like, I just think that they get one lever and they get one shot, and the data they get is flawed, and so the decisions they make can be flawed. I don't know. It's tough. Or you can go. So there's that. There's like, I believe in the Fed and I believe in the numbers. Then there's like, I believe mostly in like humans being good and doing the best with the failed stuff that they have to work with. And then there's like full on conspiracy theory, which like, hey, I mean, you could be right? Where it's just like,
I don't know if I'm conspiracy theory, but I'm definitely like, this is a flawed system. I don't know why, we don't make changes, but I don't know. I think Elon Musk might head up efficiencies board for government agencies in the future. So that might be our answer. Just put Musk on it.
Noted stable person, Elon Musk.
Yep.
I'm a Tesla driver. Anyway, let's not delve too much into conspiracy theories here, because I've got some for you guys. Popular with absolutely nobody. So I'm some people like conspiracy theories that a lot of people believe in. I like ones where like I'm the only person who believes in them. So Kyle says, do you think the next cut, if that happens, will affect the rates in a downward direction this time, or maybe flat still? Bro, great question.
Really good question. Really good question. I'll go
You can
first.
tell we don't have a good answer when we're both like, dude, this is a good question.
Yeah, well, because my first instinct is that it won't, Kyle. And like, Sean shared the charts. We fully expect, about a cut in the next 3 meetings. November, December, January. Like, that's the betting favorite, is that there'll be 3 cuts by January, and there'll be at least 2. And if you take like 2 or 3 cuts in the next 3 meetings, like whatever that percentage is, 85%, like, we know cuts are coming. And so, like, it should, in a sense, be baked in. It should be kind of priced in because it's expected. I think that what will affect rates, either positive or negative, is going to be the economic data that starts to drive the future stuff. The looking into Q2 of 2025, and all of a sudden these numbers change, and the job market isn't as good, and they're talking about we're going to have 6 cuts by June or whatever the case may be, because the near future, the next 3 months, seems to be pretty well set and planned, and like, it's going to take economic data that projects us out farther to see a shift in mortgage bonds, in my opinion.
Yeah, I think so too. I think like one of the ways you can gauge an if then question like that, and this is let's I'm gonna reshare this slide deck real quick, on this particular slide, if we can get that up there. Thank you, Caden. So one of the ways that I think about it is right now, so we have 85% chance of this happening and a 15% chance of this happening. If this happens, right? So like the actual expectation, the average expectation is essentially somewhere like right here. If this happens, then 85% of the effect of that thing has already been priced in. So if they say like all of a sudden this gets shot over here, and like those trades go that direction, and you might see slight lowering in the market where the people who were like cautious are now proven wrong, and the money has to go somewhere else. The bigger effect is, I think it's also affected, before I go on to the other one, where it's like, well, by the time of next month, they've kind of accounted for like the fact that there will be, maybe 1.5, and then 3 months from now it's 2.4, like rate reduction. So there is like, even in the future, to think about where that kind of like mitigates some of the big changes. But when you see a small percentage chance, and if that happens, right, if they decide not to change, only 15% of that effect has been accounted for in the markets right now, and you're going to see this like big melt up in rates. So my guess is, if 85% of the effect has been accounted for, then you're really not going to see like a huge change. You might see a trickle down, or that it's going to be relatively flat. Let's put that to the test. Let's revisit these numbers the week before the rate cut, before the Fed meeting, and we'll see how right I stand to be. Usually not very right. So, but we do have a big week next week. We've got a very, very bland week this week, I believe. The same weekly initial jobless claims. We do have a few Fed governors. We have 5 Fed governors speaking. None of them are Jerome Powell. We have existing home sales. But next week is going to be insane, Maddie. We've got ADP employment. So that's like ADP, the biggest payroll provider in the country. They put out their numbers about what they think about how employment has, been affected for the month of October. And then we have Q3 GDP, our first GDP reading for Q3 of 2024, which is going to be huge, right? That measures. I've heard people have heard less beef with people like the measurement of GDP, employment, inflation. Those are all to do with like our personal experiences. GDP measures something much, much bigger. So curious to see where that comes out. Came out at 3%, a yearly increase of 3% in Q2. So we'll see. Whether it's gone down, whether it's gone up, should be really, really interesting. And then we got PCE and personal spending. That's actually the Fed's preferred spending and inflation measures over and above CPI, although they typically tell the story of retail sales and CPI. So, but they are supposedly the preferred statistics. And then on Friday, we've got jobs, U.S. employment report, our like unemployment report. And those are that's the biggest week before that November 7th meeting. And I'm excited about it. I love a good PCE lining up with GDP, lining up with jobs report week. It's a triple witching.
Yeah, a lot of action, and that's those are the reports, and that's the stuff. To Kyle's question, that in my opinion moves rates much more than a meeting. At the meeting, as always, we're going to listen to what Jerome Powell says, and his words are going to be, powerful one way or another on how he talks about, how they're looking at data and what their future plans are and all that good stuff. So, the actual cut, I think, like you said, most of that's baked in. But, those numbers will be important, and we'll see. I know it's interesting times. The silver lining, we talked about it last week, and I want to continue to
take us home. Give us a 3-minute just like sermon on like why this is good for Kyle.
This is good for Kyle. This is good for anybody looking to buy in Q4. And I believe this wholeheartedly. This isn't like a sales pitch. Like, I know it because we've kind of lived it the last 2 Q4s, and I talk about it. I see people winning, and then it ends, and then there's people that were like, man, I wish I could have bought when that house went for 460, because now here we are in the spring and I've got to pay 515 for it. So like rates being up, like this morning when I saw it, the first thing I thought about, this is taking more demand out of the market. Like sellers probably need to hear this more than buyers, but if you're a seller, get prepared. Get prepared for it to feel really slow and cold. Not a lot of people walking through your open houses. Not a lot of people, buying homes during this season, especially when rates are like this. Like they reached 6.1 in mid-September. After this morning, we're probably going to go 6.7, 6.8 for like an average 30-year. For somebody with good credit and a good down payment, like some people are going to be like back into the 7s for certain scenarios. And so like that bodes well for buyers looking for a deal. That doesn't bode well if you're a seller to sell in 5 days. That doesn't bode well if like you're the wait for rates to get to 5.5% camp. But if you're a smart strategic buyer, you go out there and you find yourself a great deal, you negotiate, you get the seller to pay for closing costs, you get the house for $30,000 less than you probably would have paid 2 months ago. And then you've got the house at the price that is at a discount. In the future, you can refinance when rates get lower. The mortgage isn't the permanent piece. The price is permanent. Like once you pay 570, you can't unpay 570. But if you pay 515 and you've got a 6.875 and your payment's a little bit uncomfortable, if and when rates come down, which they likely will, then you refinance it into a 599. You're like, oh shoot, this is cool. And I got the house at a discount. And then in another 18 months, rates are at 4.875 and you refinance again. When the rates are at 4.875, that same house, because of the dynamics of demand versus supply and the fact that like 4.875 is going to push a ton of demand, there's no way that house with a 4.875% interest rate is not more expensive. That's just how it works. Like the rates go down, the home prices go up. Like
right. Yeah.
I'm no rocket scientist.
There's this popular saying like date the rate, marry the house, which is to me like a little bit can be a little bit predatory sometimes because it's like you want to make sure that the rate you actually get right now is affordable. And it's like you can really only be sure about that in a situation where you're 90% positive rates are going to go down and where the deal you get on the house today is a good deal from a price point of view. It's like if either one of those is not true, then it's like it's a little more of a crapshoot. But yeah, if you're in a declining interest rate environment and you get a good deal on a house because rates have gone up and demand has gone down, and it's like, oh, it sucks. Your interest rate's 7%. But like, we looked at this and we're like, oh, woe is me. Rates are going down more slowly than we thought they were. It doesn't change the direction that rates are eventually going, which is down.
Right. Yep. So go out there and find yourself a deal. That's my advice to anybody who's in the market to buy.
Mine too. And if you, shameless plug, happen to be buying in pretty much anywhere in the United States, call Matt.
Yeah. Go to greatmortgagebroker.com.
Get a great, what is it?
Greatmortgagebroker.com.
Greatmortgagebroker.com. Matt, it's been a pleasure as always. I know we've both got calls to hop onto. Can't wait to review these numbers and see which way the wind blows next week.
We are gonna see. I used to say that. Used to be my saying. We gonna see. So
we're gonna see.
We gonna see. Yep. Thanks, buddy.
All right. See you guys. Have a great week.